Professor Jenkins, what is macroprudential policy and why are authorities becoming more interested in it?
Well, everybody knows monetary policy. Most people will be aware of microprudential policy. The third leg of the stool, which is increasingly fashionable and of interest, is macroprudential policy. Monetary policy has as its objective price stability, uses interest rate tools, and in the Bank of England is decided on in something called the Monetary Policy Committee. Microprudential policy focuses on individual institutions and their health, uses capital requirements, liquidity requirements, and risk management standards to avoid failures in individual financial institutions where possible. And macroprudential policy looks at the bigger picture, the macro picture, in order to identify and, if possible, mitigate threats to the financial system as a whole. And given the recent experience of the last 4 years, where financial problems in one sector and one country quickly spilled over to other sectors and other countries, authorities are increasingly trying to anticipate how it all fits together and look at the macro picture.
And why is the global financial interconnectedness so challenging?
It's challenging because the global financial world is more interconnected than ever before. But the level of global coordination which is necessary to agree the ground rules to control those flows or mitigate the excesses of those flows has not advanced as quickly as the flows themselves. Britain may have very strong views about what's needed for systemic stability in the UK, but without cooperation beyond the UK, it may not be able to achieve it.
What are the potential consequences of a potential Greek return to the drachma?
Well, the issue with Greece is that a default of Greece within the Eurozone or within the Euro has different consequences than a default of Greece through an exit from the Euro. A default of Greece within the Euro means that the sovereign debt of Greece is written down. And as we've seen recently, that was a write-down by investors who, in the aggregate, including the Greek banks, own 320 billion euros of Greek debt. But were Greece to exit the Euro, and if the drachma were to come back, depending on how it came back, Euro loans to companies in Greece, the private sector, not the public sector, could also suffer losses caused by currency changes or exchange controls. And secondly, if Greece were to exit the Euro, it raises the question as to whether or not there might be other countries in Europe that might exit the Euro, and what that would mean for their bondholders and the banks who had lent money to the private sectors of those countries. So the issue is cross-border risk in Greece and sovereign risk, contagion, and cross-border risk from that contagion in an uncontrolled Greek default outside the Euro. And that is why the authorities in Europe are working so hard to build firewalls so that, should it happen, it won't automatically infect Portugal and Spain.
Thank you so much, Professor.